Ever wonder why central banks across the globe are slashing interest rates at a remarkable pace? This is more than a trend, it's a global phenomenon. Central banks, the guardians of a country's financial system, have been lowering interest rates. But why? Let's break it down. Interest rates are a tool central banks use to control economic growth and inflation. Think of it as the lever that controls the speed of a country's economic engine. When interest rates are cut, borrowing becomes cheaper. This encourages businesses to invest and consumers to spend, stimulating economic growth. On the flip side, lower interest rates mean savers earn less on their deposits, which can spur them to spend rather than save. But why are we seeing this trend now? It's a complex web of factors. Some economies are looking to stimulate growth, especially in the wake of the pandemic. Others are trying to manage inflation, which has been on the rise in several parts of the world. But here's the million-dollar question: when will the Federal Reserve join this global trend? The Federal Reserve, America's central bank, seems to be marching to the beat of its own drum. While central banks around the world are slashing interest rates, the Fed appears to be holding its ground. But why, you might ask? The Federal Reserve, often referred to as the guardian of the U.S. economy, has a key role in managing the nation's money supply and controlling inflation. Its stance on interest rates is a reflection of its assessment of the economic landscape. If it perceives a robust economy, it might hesitate to lower rates even if other central banks are doing so. This is because reducing interest rates can stimulate economic activity, but it can also lead to inflation if not handled carefully. The Fed's reluctance to join the global trend could have a ripple effect. It could strengthen the dollar, as higher interest rates tend to attract foreign investors, but it could also create challenges for U.S. exporters by making American goods more expensive overseas. So, the question still stands: when will the Federal Reserve cut interest rates? Predicting the actions of the Federal Reserve is no easy task. The decisions to adjust or maintain interest rates hinge on a myriad of factors. These range from domestic economic indicators like inflation and employment rates, to global economic developments and geopolitical events. Rising inflation, for instance, might prompt a hike in rates to temper the economy, while a slowdown might lead to a cut to stimulate spending. Now, what does a potential rate cut mean for the U.S. economy and investors? Well, on one side, lower interest rates can stimulate economic growth. They make borrowing cheaper, encouraging businesses to invest and consumers to spend. This can boost stock markets, making it a potentially favorable condition for investors. However, there's a flip side. Lower rates also mean lower returns on savings and fixed income investments. Moreover, if rates are cut too much, it could lead to inflation getting out of hand. This scenario could erode the value of money and impact the buying power of consumers negatively. While we can't predict the future, we can certainly stay informed and prepared. After all, in the world of finance, knowledge is power.